Have you ever wondered how interest rate cuts by the Federal Reserve impact the housing market and investors? It's an intriguing world filled with numbers, projections, and financial jargon that can sometimes feel like a foreign language. But don't worry, we're here to break it down for you. Let's start with the basics. The Federal Reserve, often simply referred to as the Fed, is the central banking system of the United States. Its role is to provide the country with a safe, flexible, and stable monetary and financial system. One of the ways it achieves this is through the manipulation of interest rates. Historically, interest rates have been a key tool in the Fed's arsenal. By adjusting these rates, the Fed can influence borrowing costs, which in turn affect spending, investment, and ultimately the overall health of the economy. Recently, the Federal Reserve decided to keep its key interest rate unchanged for the third consecutive time. This came as a surprise to many, as the Fed had been steadily increasing rates to combat high inflation. However, with inflation rates falling faster than expected, the Fed decided to hold off on further increases. But here's where it gets interesting. The Fed has signaled that it expects to make 3/4-point cuts to its benchmark interest rate in the future. This suggests that borrowing rates will still be necessary to slow spending and inflation, but at a potentially lower rate. These cuts could bring the benchmark rate to around 4.6% by the end of 2024, which is significantly lower than the current rate, which is at its highest level in 22 years. As of this video, the current rate is a staggering 7.2%. As we venture deeper into this topic, we'll discover just how significant these interest rate cuts can be. So what's the reasoning behind cutting interest rates, you may ask? Well, the logic lies in stimulating economic growth and managing inflation. Interest rates are like the heartbeat of the economy. They influence the flow of money from borrowers to lenders. When the Federal Reserve, or the Fed as it's commonly known, cuts interest rates, it essentially makes borrowing cheaper. This encourages businesses and consumers to take out loans and make investments, which in turn pumps more money into the economy. It's like giving the economy a shot of adrenaline, sparking activity, and encouraging growth. Now you might wonder why the Fed is considering making 3/4-point cuts to its benchmark interest rate. The reason is twofold. Firstly, these cuts are a way to manage inflation. While a certain level of inflation is healthy for the economy, too much can lead to instability. By lowering interest rates, the Fed can help keep inflation in check. The second reason is to spur economic activity. When borrowing is cheaper, people are more likely to take out loans for things like homes, cars, and education. This increased borrowing and spending can give the economy a much-needed boost, especially in times of slower economic growth. Looking ahead, the Fed is considering lowering its benchmark interest rate to around 4.6% by the end of 2024. If this happens, it could set off a chain reaction of economic activity. Lower interest rates mean lower borrowing costs, which could lead to increased spending and investment. However, it's important to note that while lower interest rates can stimulate economic growth, they also have potential downsides. For instance, they can lead to increased inflation if not managed properly, and they can also discourage savings since the returns on savings accounts are usually tied to the interest rate. Now that we've understood the logic, let's see how this impacts the housing market and investors. A change in interest rates can cause a ripple effect in the housing market and among investors. Let's dive into the housing market first. When interest rates are cut, mortgage rates typically follow suit. This means that borrowing money to buy a house becomes cheaper. For many people, lower mortgage rates can be the difference between being able to afford a home or not. Consequently, we often see a surge in home buying activity when rates are cut. This increased demand can, in turn, drive up home prices, benefiting sellers and real estate investors. Now let's shift gears and talk about the stock market. Lower interest rates can make borrowing cheaper for businesses as well, allowing them to invest in new projects or expand existing ones. This can lead to increased profits and by extension higher stock prices. In this sense, investors in the stock market can also benefit from interest rate cuts. But it's not just about the broad strokes. Specific sectors can be affected differently. For instance, companies in the real estate sector could see a significant upswing due to increased home buying activity. On the other hand, banks might see their profit margins squeezed as the interest they earn on loans decreases. Now, let's discuss the projected rate of 4.5 to 4.75%. This is a significant decrease from the current highest level in 22 years. If this projection holds true, we can expect to see the impacts we've discussed amplified. More people might be able to afford homes, and businesses could have more opportunities to grow. But, as with all economic forecasts, it's important to remember that these are just projections. Many factors can influence the actual outcome, including changes in the economy, geopolitical events, and shifts in consumer behavior. Therefore, while lower rates can provide opportunities, they also come with risks. It's crucial for both homebuyers and investors to stay informed and make decisions that best suit their individual circumstances and risk tolerance. So, as we can see, interest rate cuts have a profound impact on both the housing market and investors. It's clear that the world of interest rates is complex and fascinating. We've journeyed through the intricacies of why the Federal Reserve might cut interest rates and how these cuts can impact the housing market and investors. Remember, a lower interest rate could mean lower borrowing costs, potentially making homeownership more accessible for many. For investors, a rate cut can stimulate economic growth, potentially boosting stock prices. However, it's also important to note that the projected rate for the end of 2024 is between 4.5 and 4.75%. This is a significant figure to keep in mind for future planning. Staying informed about these changes can help guide your financial decisions, whether you're looking to buy a home, invest in the stock market, or simply understand the economic landscape. It's a dynamic world out there, and the more you know, the better equipped you'll be to navigate it. If you found this information valuable, do give us a like and subscribe to our channel for more insightful content. Check out this video right here to learn more to know about investing and finances. Don't forget to share this video with others who might find it useful. Thank you for watching.